Hi everyone, it's Jack back with another video, and today I'm going to be talking about Snowflake, which recently released its Q3 earnings about an hour ago. Not very well received by the market at all. Starts down 12% after hours, on top of down 57% year to date. You can see that 52-week high, 377, absolutely nowhere near that in the minute, $142, going to be lower tomorrow. Probably might test that 52-week low. Getting below IPO price. Its IPO in 2020 was around $120. Real roller coaster of a couple of years for Snowflake and its shareholders. Very highly valued stock, so obviously not ideal in such an inflationary environment, but it is one of the most premium SaaS businesses in many people's eyes. So I'm going to be analysing the most recent report, having some of the problems that I have with it, in particular, having a look at its valuation, whether I think it's a buy, sell or a hold going forward. Like and subscribe if you enjoyed the video. Let's get into it. First, a high-level overview of the results, and then we'll dig into them all a bit more. 67% year-over-year product revenue growth. This is slightly higher than our analyst expectations, which is good. 165% net revenue retention, meaning the average customer spends 65% more each year. 287 $1 million plus product revenue customers is really good. Large customer momentum, diversified revenue, pretty good in my opinion. And improving product gross margin, 75% non-GAAP product gross margin. Of course, that is non-GAAP. On an annual basis, revenue was really strong, up 106%. Almost all of that is product revenue. The professional services and other revenue is far lower margin and not really what is moving the needle for this business. It's obviously the product revenue, which is essentially the SaaS revenue. That was up 106% year over year, now $1.1 billion. Quarterly revenue showed 67% year-over-year growth and a decent increase on a quarterly basis. Again, almost all of that being product revenue. Revenue expectation for the quarter was $538 million, or consensus analyst expectations, 557 achieved. That's a pretty decent beat in my opinion. Probably the strongest element of this quarter for me is the customer momentum they're achieving, particularly at large customers. Total customers grew 34% to now nearly 7,300 total customers. Customers over $1 million in product revenue, as I mentioned, 287. That's 94% year-over-year growth, which is absolutely fantastic. This is a clear bright spot on the quarter for me, is that the customers, the ones who are staying on the platform, are gaining significantly in revenue and sticking with them. This customer loyalty, the stickiness of this platform, and arguably moat is reflected in very, very strong dollar-based net retention rates. But arguably this is one of the weakest points of this quarter. You can see last year 172% net dollar-based retention rate, now 165%. Now 165% is still pretty much best in class for a SaaS company. That is absolutely outstanding. However, it's still decreasing every quarter this year. This is certainly a worrying trend if it continues, and Snowflake investors or potential investors should be watching out for. However, 165% is still very, very, very good. It's just not 177%. It's not where it was, and it's one of the lowest numbers they've seen for a long time. I'm not going to ding it too much for this, but it is definitely a worrying trend that people should be watching out for. Their outlook for the full year was around $1.92 billion product revenue, so probably around $2 billion of total revenue, 68% year-over-year product revenue growth, so pretty much the same as this quarter. Non-GAAP gross profit around 75%, operating income around 3%, non-GAAP adjusted free cash flow around 21%. Now, of course, these are on a non-GAAP basis, so basically meaningless as far as I'm concerned, but you can see they're certainly coming up from where they previously were. 105% loss in full year 2020, and now they're at 3%. I mean, that's very, very strong, but again, it's non-GAAP, so I'm not going to pay too much attention to it because I do not like non-GAAP metrics at all. Product revenue is definitely declining in growth. Obviously now the basis by which it's growing on is getting much larger. It's now billions of dollars in revenue, so it's getting harder and harder to double that every year. However, this is definitely concerning for a company that is trading at astronomical price of sales in an inflationary market. So declining revenue growth rates should be of concern for people who are paying exceptional multiples for this company. I have a couple of major problems with this company, and the first one is stock-based compensation. The stock-based compensation for this company is absolutely terrifying. It's like 40% of revenue is going on stock-based compensation. That is way, 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 way too high. This really needs to be brought under check, and it's not really being done so. You can see the commitment has came down over time. It's not coming down anywhere near fast enough. This is an absolutely terrific amount of stock-based compensation, in my opinion, and something that really concerns me. This company just doesn't really seem to be that bothered about being profitable. They're targeting by 2029 20% non-GAAP operating income. That's not really that good, in my opinion. Particularly if it's on a non-GAAP basis, not including SBC. I don't think that's that impressive. They're targeting a 25% free cash flow on a non-GAAP basis. They're already at 21% and they're grossly unprofitable at the minute. So I just do not like this, and I don't like that they've got a clear path. Haven't got a clear path to profitability right now, and I can't really see them changing this at any point in the near future. My second problem, and even bigger than that, is the valuation. In today's market, a price of sales of around 25, 27 is just way, way, way too high for a company, even if it's growing revenue at 68% for the full year. That is just way, way, way too high in my opinion. In an inflationary market, one that's heading into a potential recession where liquidity is drying up, I just can't really justify a price of sales of 25. I don't think many people should be justifying this. Of course, this is a company where if you're buying it, you're expecting it to be a much larger company and eventually a profitable company in a few years, by 2029, whatever, in some time in the future, you're expecting this to be a much larger company in terms of market cap, in terms of revenue, in terms of profitability. I just think there's a lot of projection there, and I think the price of this company could suffer tremendously in the near term as revenue dries up, essentially, revenue growth that is. It's come down to 68% from over 100 previously. Can we really be justifying 25, 27 times sales? It's not consistently profitable, so it's so hard to value it on a profitability standpoint. So we're really going to talk about enterprise value to free cash flows of over 100. I just can't justify this. I don't care how cheap it is versus its historical valuations. That was in a different time, and this is looking grossly overvalued at the minute, in my opinion. And that's the summary, really. In terms of a business growth point of view, while growth is decelerating, I understand this because the business is maturing. It's not so much of an issue for me. I think that from a quarter point of view, it's performing admirably. I have massive concerns about the stock-based compensation with this company and how they're going to rectify that, because it's just not decelerating at a fast enough rate for my liking. I have massive concerns about its path to profitability, and I have massive concerns about the valuation in the sort of environment we're going in. I think this stock could end up well below $100 in the not too distant future if it carries on, and particularly in the market in the way it is. Even if the Fed announced today that they're going to be slowing the rate of interest rate hikes, it's just not a good environment for a company like this. And I believe it's going to have a really tough time over the next 6 to 12 months in seeing any sort of stock price gains. I definitely think it's more likely to go to 100 than it is 200. But of course, that's just my opinion. I definitely don't think it's a buy right now. You should form your own opinion. I'm not a financial advisor, so you should do your own research and due diligence, not just listen to me. More importantly, tell me what you think in the comments below. Tell me if you think I'm a joker. Tell you think you are also share my concerns. Whatever you think, tell me below. I'll see you again next time.